Kevin, welcome to F.A.C.E. How are you, buddy? Nice to meet you.
Dale, I'm doing good. Great to join you guys.
So, did you bring some instruments or some things that are on your radar to talk about? I usually start off talking about how people got into the industry. Why don't you tell us a little bit about your indoctrination to trading?
Sure. And then I'll tell you, to give you a little preview here, at Zacks, I am primarily a model portfolio manager. So I'm just picking stocks, short-term, long-term. And so I've got a lot of macro stuff that I want to talk about. And I don't have a planned presentation, but I have several things that I've been working on that are just part of my process that I do, every week, if not every day, looking at the fundamentals, looking at the technicals. So we'll go over that.
Yeah, that's a great company. A lot of people heavily rely on Zacks and the content they provide for investors and traders. So I didn't get that from your profile on Twitter, so that's good to know.
Probably the reason.
How did you end up over there?
Well, in the way that you and I probably know each other is through FX, because that was what I did in a former life. From 1998 to 2008, I was an institutional FX market maker, and and I was doing spot futures arbitrage for a firm between the futures and the cash market from the introduction of the euro. But I was looking for something different because they started to automate everything, right? The robos moved in slowly in the 2000s, and by then a human couldn't do arbitrage anymore. So I started looking for different things, and I was always interested in equities. And in 2008, I went and worked for a big options trading firm here in Chicago, and it was just a fantastic experience for me because I'd already had a core option.
Were they at the C-Boat?
They had people on the floor at the CBO, but they were primarily, providing institutional liquidity. I used to call them the Goldman Sachs of options. I'll just tell you the name of the firm. The name of the firm is F.A.C.E. A lot of people haven't heard of it, but they ran large volume in a lot of equities and their options. And
I didn't know. Were you born and raised in Chicago, Kevin?
Yeah, I was.
Interesting.
Yeah. So I mean, so much has happened here, right? The IMM, right? In 1971, Nixon kills the gold standard, takes the dollar off, and right away, Leo Melamed at the CME was working with Milton Friedman to, how do we justify and validate that we need currency futures in a floating, free exchange market, and they pulled it off. I mean, from the time that Nixon closed the gold window in August of 1971, the CME futures, the IMM, launched in the spring of '72. That's how motivated and ready.
I was there above Riverside. State on Riverside Plaza Drive, and actually I was running orders out to those IMM guys, and they were trading off a chalkboard.
Yeah.
You remember that?
Oh, well, no, that was before my time.
Maybe I'm imagining it.
No.
I didn't know we were going to be talking about this kind of ancient history in the market.
Yeah.
So, God, you've been doing this a long time, buddy.
It's funny. I got a good tie-in for the ancient history because I didn't walk on the floor of the CME there on Riverside until 1994, and now I work right across the street. But let me show you a chart.
Now they're bowling alleys.
Well, yeah.
Right.
Nothing we can do about that. Hey, can you see my screen?
Got it up there, looking at the S&P.
Yes, and do you see that time period? That's 1994 right there.
Okay.
So can you see that?
So you have some type of fractal from 94 you're using for 2018?
What's interesting, I mean, yeah, you could say that. And I don't use the word fractal all the time, but I look for patterns of history rhyming. And so what's interesting is this chart was actually made by another trader, and I borrowed it from him because it spoke well to several themes. Who was your last speaker you had on presenting in the previous hour?
Steve Bulgy.
Okay, that gentleman referred to the correction in time that the S&P has been going through, and I agree with that. That's been one of my themes. Is like, when is this thing going to be able to get away from the 200-day and 2600? You know, is it? And finally, we've exhausted the bears, I think, and and there's enough confidence, despite any trade war fears, we can take it higher. So the idea is, at first I was calling for a V bottom in February. Well, we got one, but it wasn't solid. So then we had to revisit it with the W bottom theme, and then even the W bottom wasn't good enough, right? Here, you know, we can't even. We're making higher highs in the NASDAQ and in semiconductors, but the Dow's breaking down, and so then it looked like, oh my gosh, do we really have, you know, what is this going to be? What kind of bottom is this going to be for the S&P in this correction, or is it going to extend further? So here's the analog that this trader came up with, that, hey, triple bottoms happen all the time. You know, maybe that's what it takes here. And so, you know, and that's kind of what the S&P has been working on. And
so where do you think the S&P is in comparison to this chart now?
So I think that the S&P has created its bottom. So we had something of a W bottom, and the NASDAQ held on to bullish structure. And by bullish structure, I'm talking in the simplest terms possible: higher highs and higher lows.
Yeah, especially the NASDAQ 100 looks like it's incomplete.
Yeah.
I'm looking for a third drive up there. But getting back to this chart, would you say the S&Ps are kind of in the position as they were on this chart, say in February?
Well, you see this correction. This correction you're looking at from 1994. Look how long it really took to make a triple bottom. It took all the way until December to confirm that, and then we went into a long bull run. Now we're the
so we could make lower highs in the S&Ps, maybe a higher high in NASDAQ, and definitely a lower high in the Dow because of the bifurcation.
Yeah, I mean, I think that the S&P is going to get it done here. Obviously, we still have trade war fears, and we still are in the worst 6-month period that comes every 4 years, and you know what that is, midterm election season. So there's plenty of reasons to just sell and hit the beach, but you know, we're in the middle of one of the strongest earnings seasons ever. So let me use this chart to also tell you a little bit about my history. So this chart, you see 1994, you see that collapse in March that the S&P experienced? That was when interest rates started to rise. Remember that?
Mm-hmm.
Yeah, so I was actually working as a telephone refi guy, you know, where you cold call people to refi their homes. And I did that job for about 2 days, and I quit because not only did I not like cold calling people at home to ask them if they wanted to refi their home, but interest rates had just spiked higher in early '94, and that's why the stock market, you know, fell off the map there, you know, from S&P 475 to 440. So it was really hard to get, you know, it was like credit conditions were tightening. So what's interesting is I leave that job and I go find a job at the Merck as a clerk, right, in April. And so I came into the markets at a really exciting time where interest rates are rising. How can this be good for the stock market? And then a year later, we enter one of the greatest bull runs ever, right, from 95 to 2000. So that's why it was kind of fun to show that chart. But I've got some more charts to show you, stuff that I'm looking at here. Let's get rid of this guy.
So you're pretty sanguine here looking for new highs. You agree that time is more important than price. So what do you think timing wise?
I think the market is telling us that. The market is telling us that it can work through this in time because there's all this, you know, we've got uncertainty about the trade war. We really don't know what the White House is going to do next and how it escalates. So, that creates uncertainty for corporations. And I haven't heard a lot on conference calls where a management team is saying, hey, you know what, we're a little bit worried about what's going to happen with trade. So we're holding off on this, these expansion plans or whatever. You're not hearing that overtly. But since the uncertainty is there, large investors are kind of anxious and playing it cautious too, because they don't know which way it's going to go. Is it going to escalate or is it going to die? Can you see this article I wrote on May 2nd? Stock market waits for trade war to rage or die. This is actually a video I made and
you think
an article.
Do you think that it's going to escalate past it being a negotiation?
Unfortunately, I think the White House's strategy and approach is too chaotic for anyone to know, and that's the problem. Is that even if this turns out to be a clever negotiating tactic, we just don't know how it's going to unfold. It could be this tit for tat thing. Last week at the Milken conference, one of the co-founders of Alibaba, his name is Joseph Tsai, I think, he said, "Hey, this is probably a really bad time for a trade war. You've got the largest middle class in the world, which is China, arguably over 500 million people, that are waiting to buy American products. So we could be shooting ourselves in the foot, even though things need to be done, even though China there may be some unfair practices that need to be addressed. Having a brawl about it, I don't know if that's the best way. But regardless of my opinion, the point is what are large investors doing? What is a Steve Mandel doing of Lone Pine? Or, what is Ray Dalio doing? What are these guys that manage billions of dollars doing right now? Are they buying stocks based on this uncertainty, or are they just? I've called it a buyer strike, and that's why it became a correction in time, because we've had sort of a buyer strike.
And wouldn't you consider it bullish that retailers have been pulling money out of the market at a pretty fast clip this year?
Relative, using retail sentiment is. I think it plays a role. I like to look at. I still like to look at Investors Intelligence. One of the oldest sentiment surveys, which are the newsletter writers like me. And in January, mid-January, the bullish sentiment was off the charts. We were at highs. It was over 4-1 bulls to bears in January, which we hadn't seen anything that high since 1987. And that's when I said, hey, that's when the Dow just kind of went vertical. I'm like, this is not going to last. But then we go to this other extreme, this malaise sort of, over the trade war, or potential trade war, I should say. And, it's just, we're having to grind through it, waiting for buyers. So I want to show you, so we've talked about the bullish structure that the NASDAQ maintained, and even the SOX index had it until it lost it. Let me see if I can find that chart. I actually was a buyer of, let me show you here. I won't. So can you see this? I added to LRCX on Friday. So Lam Research is one of my favorite, semi equipment makers. I added there just because I thought the semis can really pull this off. And I have to find my semi chart where I paint sort of a inverse head and shoulders. Let's see where I put that puppy.
And next, I'd like to ask you about what's been happening in energy. Kevin, about 4 years ago when crude was under $40, and all the economists said, well, that's really a tax cut for Americans because they have that much more money in their pocket. Well, they can't have it that way and then not say $70 crude, and if it's heading higher, is it going to have a deleterious effect on consumer? What are your thoughts there?
Yeah, I mean, here's the thing with fundamentals, is you can pick out individual fundamentals that matter to the market, the thing is they don't matter that much, and they take a long time to play out.
Yeah, till the tipping point. Yeah.
Yeah. So cheap oil was a tax cut, but there were other things going on too. And so I try and look, when I look at the fundamentals like the economy and earnings, sometimes I try and back up and go as big picture as possible before I make a decision to go to 50% cash and start listening to the bears. I say to myself, well, what is the economy doing? Oh, the economy is still growing at 2.5%. That's a positive for equities long term. You know, and what are earnings like? Are earnings still accelerating? You know, I mentioned the potential trade war several times, but the fundamental that I didn't mention that matters more is earnings. And if you want to look at the glass as half empty, which many investors are, is have we seen peak earnings growth? If we are seeing, you know, some of the best earnings, you know, like Q1 is the best Q1 in 7 years, and you look at technology earnings growth. I'm going to show you some graphs coming up of just say, you know, the technology sector. I mean, 23% earnings growth in Q4. Well, sequentially, we're not going to be able to top that, but year over year, we're still going to be beating. It's just that the rate of growth is declining because the comps are getting so much harder. So some investors are going, hey, we've seen peak growth. The best is behind us. Time to sell stocks. Before I show you those earnings graphs, can you see my SOX chart here?
Yeah.
Yeah. So this is what I started looking at. I posted one of these on May 1st on Twitter and again on May 2nd. This is sort of my hope. It's like the semis, either they're going to break down, you know, beneath this support level, which, you know, you could call an inverted head and shoulders, but this 1200, 1225 level, you know, 5% lower and it's lights out, or, you know, we've got 20 to 25% upside. Because
I know if you lay up that chart against the NASDAQ 100, the SOX looks like what the NASDAQ 100 could do for the third drive. So SOX is ahead of it, and maybe you could get a new high in NASDAQ 100 and just a retracement in the SOX.
Yeah. See, what happened for the SOX? Well, I mean, the SOX, I'm bullish as long as the NASDAQ holds up and the SOX holds these lows. You know, we had this bullish structure where early April was a higher low for the SOX, and then what did we do? Took it out. So then I was getting worried, but you know, everything else has been so strong. So let me get rid of this chart here for a second.
I don't know. I just prefer to be long the relative strength and sell rallies and relative weakness.
Yeah, I mean, you know, if you're depending on, you know, and it's all about your time frame too. We hold a lot of stuff for a while. Alibaba, we've held for over a year now. So I'm running a short-term tactical trading portfolio here called TASER. Stands for Technical Analysis plus the Zacks rank. And yet, when I find a fundamental growth story that smart investors are not ignoring, like Alibaba, the Amazon of China, then I stay with it. We bought Alibaba last year at $100, and we still have some of those shares, and we just added recently under 180. And I don't think, I don't know where it is. I suppose I should look before I talk, but there's my U.S. dollar chart.
So for people, you run a fund as an RIA, as a hedge fund manager, in what capacity?
I do not. I do not. No, I am not an RIA. This is a model portfolio. So
I see. Okay.
People who come and subscribe trade their own capital.
Okay.
Yes, exactly. A model with real-time recommendations. You know, as soon as I'm buying or selling, members get an email or a text alert about what I'm buying or selling. So
and this is part of Zacks or separate from Zacks?
No, this is part of Zacks. Yeah, okay. TASER is part of Zacks. Beat the market last year, beat it in Q1, and just continuing to look at economic and earnings fundamentals and staying with tech because, you know, that's where the growth is. Let me see if I can find my earnings charts here. This is an article I wrote May 1st on Lam Research. If anybody wants more details on Lam Research, just come to Zach.com, type in LRCX, and you'll find this Bull Today article. Let me see if I can find my earnings charts here. Oh, we'll go to this. We'll go to my technology supercycle theory. You know, for 3 or 4 years, everybody's trying to call the top in semiconductors, and you know, it just doesn't happen because this time is a little bit different because we have so many new technologies and industries, you know, from mobile, the cloud, and AI that are extending the cycle beyond what anybody thought was possible. So here's a thing I wrote in December to try and help people understand what was going on. Why could the technology supercycle persist? And it has to do a lot with, you know, big trends in the economy. Like, why is there no inflation? You know, why has there been no inflation? So, you know, you've got all this economic disruption from new technologies, and what happens is they create productivity that you can't see. When the U.S. government issues a productivity number, there's so much of the government in there that hides real productivity growth. But if you look at individual industries, say in technology or in healthcare or something, you're seeing 3, 4, 5% productivity growth. And then the other missing link is inflation. The inflation doesn't show up because the cost of everything goes down. Everybody's familiar with more. What's that?
Let me ask you this. Is Zach's planning to put in robots using AI to replace guys like you and me?
Not at this time. And believe me, I'm on the.
We have, buddy?
I'm on the lookout for it because it happened to me in FX. I got replaced in FX.
Okay.
But you know, I've interviewed the guys from I can't think of the name of the company now. Guys running they're running you know, an AI system, and it's coming. Listen, I think the big firms are already experimenting with it. Morgan Stanley's experimented with, I know, and so it could come out of nowhere. I mean, I could be gone in 5 years. You know, it's just something I have to accept. But
okay, well, I tell you what, we'll exchange phone numbers.
Yeah,
and we'll still talk to each other if that happens.
So here's an important chart. This is from NVIDIA. Now we all know about Moore's. We all know about Moore's law, where you know, microprocessors, you know, shrink and double capacity every 18 months.
Right.
But that started to level off. You can see those are the blue lines there, the blue dots. What NVIDIA says is that GPU computing will extend and amplify Moore's law to give us incredible productivity that is almost hard to imagine across industries.
And for, you know, amateurs like me, what is GPU computing?
Oh, I'm sorry, graphical processing unit. So originally invented for games, right?
Yeah.
They were originally invented for games, but what Jensen Huang figured out that he could do with his GPU graphics chips is he could do parallel processing on a scale, just an unimaginable scale. So instead of having a supercomputer with 6 mega-core Intel processors that still have to do serial inline processing, a GPU computer can have thousands of these tiny cores that can all be calculating simultaneously. And that's how you do AI. That's how you do AI machine learning and AI deep learning. You know, so that's what's driving so much of data analysis and what we're going to be able to do with autonomous vehicles. So that's Cooker's Tech Supercycle. And you know, I put it out there, and a lot of people say, no way, you know, chips are going down, and here we are. Back then,
I'll tell you what, I had no idea what to expect. I didn't, and you know, I went to the website that you had on your profile, and I didn't know about Zacks. So, the best way for people to follow your research and subscribe would be what?
Definitely just come to Zacks. You can read a bunch of my articles for free.
Okay.
You know, like this one here. Actually, I got to go back in here. So if you just go, you know, you can find my page, Kevin Cook. You can find some of my recent articles. Here, let's take a look at 4 earnings growth charts you need to see. Take a look at this article because it has the earnings growth charts. I want you to see where a quantitative fund manager could be cautious to bearish looking at some of these charts. All right. So here we go. First of all,
Great website.
let's look. The first thing you're seeing is this is the S&P 500.
Yeah.
Here's the historical earnings growth. Q4 was 13%. This Q1 that we're in right now, I mean, it started out at 16% growth.
Yeah.
Now it's well over 20% year-over-year earnings growth for the S&P 500. Now Q2 that we're in, there's no sequentially it's going to drop, of course. How can it top 22%? But look at these year-over-year numbers. Year-over-year, Q2 is going to top last year by almost 18%. Q3 is going to top last year by over 19%. This kind of growth would make investors buy. Fund managers are like, pedal to the metal, interest rates are still low, the economy is still accelerating, you do not go to cash, you do not talk about bear markets, you do not talk about recession, you buy, because the cycle is not over and we're not at euphoria yet either with sentiment. So
yeah,
that's a very
I know some guys looking for 4,200 in the S&P by the end of not this year, next year. And
is that a technical call or is that a technical call or a fundamental call?
It's a wave count call.
Okay, that's technical. Okay. And that's great. But I'm telling you from a fundamental perspective that this chart, this kind of data tells fund managers to stay long and keep buying on the dips. Okay. Now let's look at the problem child, which is not really the problem child. It's the hero of the stock market. It's the technology sector. So here's the technology sector. Look at this growth. I mean, this is why I've been pounding the table on technology. Yeah, you stay with. What's that? Yeah, why it led, exactly. Yeah, and so what kind of situation do we have now? Well, we have a situation where Q4 was the best ever, probably never to be topped again, 24% earnings growth in a quarter. And then the current quarter is strong, not as strong, but we're going to get all these sequential drops. Now, this is still year-over-year growth, but we've seen the peak in the rate of growth.
Got it.
Is the thing. And so that makes some technology investors cautious. Now, especially if they've got profits that are 3 years old, then they're like, okay, I'm selling my NVIDIA, I'm selling my Lam Research, I'm selling my Micron, because, that's if a fund manager owns 1 million shares or 5 million shares of something, he needs time to get out. So that's why they're going to sell into rallies, and that's what they've been doing. But I think that this growth is still a reason for a nimble technology investor to stay long and to look for new highs. I'm looking for new highs this year. I don't know. I can't say we're going to see them this summer because it could still be a rocky summer into the midterm elections. And who knows what happens with the White House trade war. So it's a time to be nimble. But I think the bottom is in as long as, there's nothing really bad that happens with the trade war.
Well,
all right, I've rambled on, and we can.
What a great perspective you brought in here today. So I really appreciate you being with us, Kevin, and I wish you continued clarity in what you're saying for people. And you're my trading warrior brother, and appreciate your time today. And I hope success follows you for the rest of your career before we're replaced by AI robots.
Exactly. All right, Dale. Well, thanks so much for having me.
I still think they won't be able to teach them trader intuition.
Absolutely. And you know what? Even when I traded against the first robo in 2001, and that was Monroe Trout. You know who Monroe Trout is, right?
Yeah. Yes.
Monroe Trout was clearing a Rand Financial at the CME, and I traded against him electronically. And it was the first robo, and they've gotten better. But I've always said, even after the flash crash in May 2010, that the machines will eat themselves. The machines will kill each other, and so there's always going to be opportunity for quick and smart traders.
I concur. So thanks again, Kevin. Great meeting you. All right, so keep in touch. We'll do this again. We'll see how things are progressing, maybe in the fall. What do you think?
Sounds great.
Okay, Kevin. Good hunting.
All right, Dale.
All right, that's a wrap for us today. Space Warriors, if you have any questions about brokerage houses, remember, go to our sponsor, Forest Park Futures, and give Trent a call. See everyone for Turnaround Tuesday. And remember, don't just count your pips, count your blessings. You're welcome. See everyone tomorrow. Thanks again, Kevin.
Adios.
Adios.